Hello ladies and gentlemen, and welcome back. Well, in today's special weekend edition of the markets around the world, including stocks, commodities and cryptos, we'll be taking a look at under the hood for the most important level of 2022. 1, 2, 3 times this has been the stopper of every market around the world, and it's basically caused a big turnaround. Will it be that way again? It's about to do a gap fill, and potentially all of this happens this week. So join us as we cover everything around the markets, including the macro, the lead indicators, and the key levels that you should be watching. Well, welcome back everybody to the daily show here where we talk about markets. As we mentioned, the macro, the lead indicators, and of course the key levels we'll be covering today's show. But let's put things back in perspective. It's really tough during these times to just feel like you've got to rally in. Now, as a trader, you're looking for statistics. As an investor, you're saying, is this the bottom? Let's put things back into perspective. Since World War II to current, the bear market returns on average have usually produced worse bear market periods. 25.4% is what we've seen so far in 2022. The other thing is that we have now had a month of positive returns, and that's 10.6% in terms of turnaround period. Now, is this a good sign? We're certainly in line with previous bear market rallies, and we know that if that does continue, 3, 6, and 12 months out looks incredibly fantastic if it is the bottom. In fact, sometimes you can still have a lot more on the table, between 10 to even 30% extra profit over that next 12-month period. But it is about putting it back into perspective. Here's an S&P 500 relative forward PE of the bottom S&P 500 stocks, excluding, of course, some of the top ones. And what this shows us is that, like a lot of these other PE ratios, we're starting to move one standard deviation to the downside. So are we in relative fair value? I guess you could say yes on some of these stocks. Possibly they are the areas that, if we believe a recovery is coming through, will give superior returns. We know, of course, recently the big stocks have started plummeting, but the smaller stocks have certainly been hit the most during the 2022 crash so far. It's also important to understand that there are multiple different metrics. Of course, we have China potentially making changes to their COVID zero policy. That's certainly a positive thing. At the same time, we have the catalyst of inflation coming off its highs, as we discussed in the previous video, and starting that turnaround. Now, generally, that has marked the end of the inflation peak. And now the question is, how sticky is it going to be? But we also have, let's say, politics coming into it. If it's a split Congress, that's actually positive for stocks. In fact, split Congresses have predicted and projected the best returns for stock markets over, a long history of periods. So basically, again, split Congress is not necessarily a bad thing for the markets. So things are starting to look a little bit better in that case. And what that means is that when we look underneath the hood, as we always do here on the channel, so make sure you subscribe if you're interested in this stuff, consumer discretionary has made a big change. Now, as we know, we want XLK, semiconductors, which has been doing quite well, and XLY coming with a recovery. Up until realistically the inflation report, we didn't have either of those. Now they've been the best returners. Communications, XLK, and XLY coming off the bottom of 4% has done a 10% plus switch pretty much across the board for these particular sectors. And this has taken over a 5-day average. So it's very powerful what we're seeing in these markets right now. Just before we jump into the charts, I wanted to give a quick shout out to the members of the community. As you guys may know, we're giving a giveaway just to say thank you to everybody that's been subscribing, following us on the socials such as Twitter and Discord, and of course, just being awesome members of the community. And if you're interested in entering the competition, it's free to do so. All you need to do is jump on over to the link in the description down below, and of course, fill in your details and then press submit. We'll be doing the live draw on our Monday open live stream. So if you're interested in coming and seeing it live, you can obviously do that. And we hope that each and every one of you has a very good chance of winning one of these fantastic prizes, including one of the group mentorings with me taken in the start of 2023. All right, let's talk about the VIX. Let's discuss now the markets around the world. VIX here, 22.53. So it's dropping down and it's basically moving back to what we call a normalized market. Remember, 20 on the VIX is considered normal. Now, does this look familiar? Well, actually, it looks incredibly familiar to that 2008 discussion we've been having. And things may be lining up better than you may discuss or think. moving forward. So here's 2008. We can see that it dropped back down to just underneath 20, the calm before the storm. Here it is, spikes up to 30 plus, comes down to 20, and then all of a sudden it went haywire. Then we got that really big fearful period. Generally, markets bottom or tend to bottom with a high VIX. We haven't seen that in 2022 so far. So definitely the bear camp will be saying we have not seen maximum fear, maximum capitulation yet. And we certainly haven't seen our biggest trend line on the stock markets getting bashed around. So is it yields? Well, yields have dropped, certainly, but they haven't actually dropped that significantly. Look at the dates here. So again, we look at dates, 27th of October, we're back down to kind of that period there. We'll look at that with the S&P 500 soon. Remember also September 27th. So we're back to a new norm of yields, but maybe the fear is starting to come off on the peak. Data-driven Fed. If bad data comes out in the next coming weeks, again, we could be going into some fearful periods of time. Watch this level. It's going to be worthwhile alerting. And as we know, forward yields are all starting to drop down. So we've got the 10-year here, 3.85, definitely a new low there, which is showing us that maybe the economy is partially sick, but the Fed might have to start doing cuts sooner than later. And of course, April, we're looking at 4.84%, still very, very high, but potentially 2 cuts by the end of 2023. That's off 0 cuts in previous data before the inflation. So things are starting to potentially turn around. It's looking more healthy, but does this mean we have to jump in? What about the bonds? Well, bond markets certainly have reacted, and it hasn't been negative at all. Yields, as we saw before, have been sitting now for 2 days. So as pure risk on, we're seeing things like high yield bonds actually jumping up. The yield hasn't changed, but the bonds continue to drive higher. That shows us that the bond market is semi behind this rally, and they're certainly thinking about taking some of this risk back on in these markets. Conversely, we've seen the US dollar continue to go lower. In the previous video, we talked about this incredibly big demand zone, and we didn't even see the reaction off it. It kind of started bumbling around and then just made a new low. And of course, now what it's done is it's jumped to this area, and potentially it may go down to this 105 zone. Now, if it goes to 105, what's that going to correlate with? Remember, these markets are all correlated in 2022. The US dollar with the S&P 500, with gold, with all these things, they all seem to be in conjunction. Well, basically, if we get a 105 DXY rating, we're probably seeing an SPX at around 4100. And these could all collide together to show us a synergy of a very key zone that we need to be watching. So remember, setting alerts is going to be key, and having these alerts for new lows or even structural highs on things like the DXY is going to be one of the most important charts over the next coming days and weeks. If we scroll down to the 2 hour, there's no signs of recovery yet, but we are at that first critical zone. If you go over to the left-hand side and have a look at the structure of markets, there's a chance it could buy here. We haven't seen that. So for now, it's still weakness in the dollar until proven otherwise. The reason we're saying that there could be a move around in the DXY and we have to watch this zone is, of course, the highs here in the euro. They coincide with each other. This one coincides with the 105 for, of course, the DXY, and also probably SPX 4100. And it's all happening in some form of synergy. So we're at our first level. If we bust this level, we most likely move into this zone. And then at this point, we start to figure out whether we've got some form of turnaround story. Remember, previously, this area held the market before it turned around. So there are no doubt some orders that sit here that need to be watched and need to be seen to be potentially reacted to by the street, by the composite man. Let's turn over to gold. Gold is very strong, and I am happy that we have been incredibly bullish on gold in the last week, and because it has basically kept up with most of the market turnaround. Now, gold as a pure commodity and gold as a stock are obviously a little bit two different things. We definitely like gold as a stock more than even this one, but it keeps running. And if you look at it on a weekly here, the teller was the triple wicks. So remember that, guys, triple wicks, the accumulation. It wasn't exactly at the zone we thought it would happen at. But what did occur is now we have a very strong, of course, double bottom base, or even triple bottom, some people are calling it. And we have that potential towards that 1800, 1808 gold area. Now, if it hits that, what do you think we're hitting? We're probably hitting 4100 on the SPX. They're all connected to a degree. So if this keeps going up, that would be potentially that turning point. If we go down to the 2 hour or even the daily, I'll just pop it in the daily here. Gold even blitzed this area, so clearly some rallies coming on here. And as I go through the week ahead videos, as we push them out each day, remember we produce them every day of the week, what we'll be talking about a lot is gold rotation. Are we seeing the biggest money coming back into it? Because gold likes two things, lowering interest rates or flatlining interest rates in a stagflation economy. And both of those seem to be the biggest play statistically right now. I won't focus too much on oil. Oil actually ended up barreling through this high here, and that began a rally. Check out our previous videos and the way we discuss things. But realistically, it's in the middle of both these areas. It's not that easily statistically pickable at this zone. XLY, XLP, we're going into the markets now. I want to do this before we talk about some specific stocks and indices because we are seeing a pretty big turnaround in this. Now, if consumer discretionary continues to bull up, of course, if it then rallies through this in the future, which no one will like to see that if they're not in the markets, this usually ends up telling us whether we're in a low, basically a market bottom. You want to see XLY and XLK and semiconductors leading the charge if you are a bull in this rally. And if we get through something like 4100 on the S&P 500, that 4100, 4130 zone, then we're seriously looking at this potential, because when we look at the US Fight 100, when we have a look at some of the other charts, it looks very, very positive for a few of these markets. Let's now discuss US Dow versus US 500. This is old economy, being the Dow, versus the US 500, a shift or change. In recent weeks, it was just all about the old economy. Since the inflation numbers, it's all about consumer discretionary, technology, the new economy. And we would expect that rotation to occur should markets continue to go up. A strength in those, more, growth sectors. Let's have a look at Tesla. Tesla bounced off that 180 area that we've heavily discussed in the last couple of weeks. Congratulations to people that were buying around that 177, 178. I guess it's doing pretty well. It's mostly in line with the markets. Tesla still is relatively weak. The way you want to look at it is if it goes past 240, that should be a good sign of continued strength for something like Tesla. If we go into the 1 hour charts, again, it's mostly in line with the markets. We're filling gaps and we're getting towards really a period where some people may say, well, this looks like an inverse head and shoulders, and that's starting to happen on quite a lot of stocks. So certainly things aren't looking weak on markets like Tesla and Apple and others for now. The recoveries are mostly doing quite well. Here's Apple. There's the double bottom for people that have been buying it. Congrats. Again, looking pretty strong. If we get to 4100, you'll probably see Apple around this area here, and that will be, a potential chance of resistance, and we'll discuss that in just a second. Let's now move over to the US 100, the Nasdaq. Pretty strong weekly break. Let's have a look at the weekly here. So weekly has closed above. Now, this reminds me a little bit, and we still have to be incredibly cautious of this, of some previous times where we've seen breakouts. Remember, people are going to look at this as a range, rightfully so. They're going to say, well, this is a very nice range. What we don't want is this. So see how we have a range here? We break the range and then we go into a holding pattern between a zone. Let's say 12,000 being the high end. Remember, there is supply here, so 12,000 is certainly a target I could see markets hit. And if we go into this range, some people will call that SOS within a Wyckoff accumulation zone of max pain, all these other things. If that happens, then we drop. Watch out down below. Look at the reaction last time. Again, that could be very, very scary. So it does look like the recovery is happening in terms of this base. It's going to most likely try to target something like that 12,000, you would think. And the way that the market's moving is incredibly aggressive. There has left quite a few gaps behind, and we'll use the S&P 500 to demonstrate this. But yes, it's above, and you would think now that market pullbacks should be met, just like we discussed the other day. The pullback that happened on the Friday session was instantly met by buyer demand, but they're not very deep yet. It's just an incredibly aggressive trade. Everyone's piling in. Usually the market will come back to get liquidity at some point, but patience pays, and that's the thing. We always say patience, react, don't predict. In some ways, it's the temperament of a trader and investor that makes you good or not. If you think about Buffett, you think about Munger, you think about Druckenmiller, some of my favorite investors and traders, these guys all have incredibly similar temperament. They do not feel FOMO, nor do they feel fear. They look at things objectively. S&P 500, this is the chart to watch. Gap fill around that 4108. We also have, of course, a supply previous, I think it was CPI that actually pushed this through. We're rallying very hard, and this market tends to give the better signal. We also know that we've left behind a massive gap fill, 37.46 from the CPI day. It just basically blitzed it. By the time the market was open, it already had almost a 3% gap. So if markets do drop, this will be a zone that I think many people will watch. And potentially, if we believe this is truly a rally, we keep seeing the rotation into the sectors correctly, that might be where bulls start to go, yeah, I think this bottom's in. Do we know that yet? Unfortunately, no. It's always hard to call it. And we've only seen 2 days of realistically strong buying of the right types of sectors to get us out of it. US 500 futures is very similar. Some people have obviously been trying to short it, and it's going to be very, very tough to short this without hitting and seeing an actual real turnaround. There's not much structure on the left-hand side here. So the problem with this is what stops this market ahead of these numbers. And it doesn't look like there's anything there because there was so much illiquidity due to that news event and gaps that you've got to think that maybe this market continues to blitz and basically create an incredible rally that's what we call a face ripper or a strong melt up. Let's have a look at the options this week. It is not in the best interests of the market to go down too much. This is all perfectly timed as far as I'm concerned with options. The biggest options expiry is the 3rd week. 4.826 million options expiring, and maximum pain sitting at 381 and stock price is 398. These are the weeks that do tend to go more towards maximum pain than any other week. I wouldn't usually use it any other week, as we've discussed several times. But look at these calls starting to come out here. Calls all of a sudden all over this strike as people start to FOMO in. And this is what I'm watching. We will talk about it a lot this week, I'm sure. Hundreds of thousands of puts on different strikes, calls coming out, people now going to 420 and 430 calls this week. That's some YOLO right there. And it's getting interesting because we haven't seen call buying like this for quite some time. It's amazing how with a click of a finger, everybody changes. You can see it represent the options, and now we've got to start thinking objectively about it. Bitcoin, frankly, still looks disgusting and really weak. There's obviously multiple scandals coming out about FTX, FTT. I'm not even on top of all of them. There's so many coming out every hour. But from the surface, it looks like it's probably some kind of flow-through effect that's going to go through other companies. I've already seen many effect. I won't talk on them now, but we'll discuss it in the live stream. Join us Monday, 1 hour before the market opens in the US. And yeah, the reason why is because there's so many intricate parts to this. There is billions at stake everywhere. It is flowing around, and I think it definitely hurts crypto's, let's say, integrity for now, and it's going to keep bears in this market. This should already have recovered quite significantly with the stock market if it was going to. And it looks like we might be going towards that premonition that many of us had was negative 83% to negative 86% on Bitcoin, the average of the cycles, pushing us potentially down to that 11.5, 9.5. Doesn't mean I'm trading it, but if it does happen, our prediction or our concept was before February of 2023, well, right now you've got those catalysts. Is there anything to like about this market? Not really. I mean, yes, it's basing, tight range, very little liquidity, and you can tell that people are scared in this one. Anything that comes out, a bad bit of news, could shock it another 20% easily down. So be careful in the crypto space right now, guys. What about for the week ahead? Do we have much? Not too many policies. Of course, people will be looking at these other bits of news. We've got the Empire State Manufacturing Index, 8:30 a.m. And we've got the PPI, 8:30 a.m. on Tuesday for the US. Then we scroll down, we've got some CPI coming out for the CAD. That might be interesting there. Monetary policy from a few other central banks. And then we go to the Philly Fed Manufacturing Index. I think this week is really about options. So join us on the channel because we'll be covering it every day. And we'll have to see what happens with the calls especially and where those strikes start getting stacked so we can potentially find out the next move for these markets. Thanks so much for watching, guys. If you enjoyed the video, subscribe, smash that like button. We'll see you in the next one. Bye for now.